Hey everyone, and welcome back to Your Money Your Life podcast, episode 242 of the pod. Make sure wherever you're listening, you like, subscribe, 5-star rate, and review this podcast because we have a lot to get into. First in the news, let's dive into the market update of the week. We'll discuss a lot of things, primarily the big move by the Fed, which we've been talking about on this podcast for maybe the last two, three, four. It's been a while. It's been a while. We've talked 2, 3 years. We've been talking about what the Fed's move will be to combat inflation. And then once they felt like inflation has been attacked sufficiently, their move to now, their move to now realize that inflation's been attacked and now say, okay, inflation's been it's at a point where it's been handled. We can now move forward with our other mandate, which is jobs, the market, the recession, potential recession, combating the recession. So that's the biggest news to date so far. What we saw was the Fed, in a surprising move, decided to cut interest rates by 50 basis points, which is half a percent. You saw the moves when we were going all the way up with interest rates being raised. They were mostly 25%, 25 basis points, excuse me, 0.14% basis point moves up. But now you're seeing that the Fed, in a surprising move, they slashed the overnight lending rate to 4.75 to 5% from 5.25 to 5.5% on Wednesday, which came as a surprise to investors who said that, okay, we're probably going to get it 1/4 of a percent basis point rate reduction, and we got a half a point rate reduction. And a lot of people are saying it's a big move. It's an aggressive move, right? Because this is only really can say two things, right? That they think a recession's on the way and they need to move fast, or that they're going to print a bunch of money to keep the economy going, and they're going to stimulate the economy with pretty much artificial money printing, right? Like moving things around to make it so that we don't go into some sort of slowdown economically. And so that's what moved the markets yesterday. First, you saw the reaction on the markets when it was announced in the afternoon. Markets ticked up. Then, when Fed Powell spoke, they came back down. And now this morning, as we look at it, the market seem to like it. So far, the market just opened as we're recording. S&P 500 is up 1.5% roughly, and the Nasdaq is flying up 2% roughly. So the market's pretty much saying they like the move now. So are investors anticipating that they're going to steady the economy with printing and ease and stimulation, or that we're going to evade a recession, which is the other backdrop of this when they do such a aggressive rate reduction. So that's the big thing. We've been talking about rate reductions for several times, and every time I have a conversation with a client, it's okay, just be prepared. Rates are going to move. And what does that mean? That also means your savings rate will start to go down. All your high yield savings accounts that you had before, you never used to put money in there because you would just get 0.25%, which is still a little bit better than maybe the 0.001% that your regular checking or transactional checking or savings was giving you. High yield savings wasn't giving much, definitely wasn't giving a percent. It was giving maybe half a percent or 1/4 of a percent until rates raised to where the levels they are now. So you will start to see your high yield savings accounts lower. You won't see your credit card interest rates lower, right? Because that's not part of this, right? So it's a really interesting dynamic is you will see potentially some mortgage rates and some car loan rates go down, but the credit card rates kind of stay where they are, stay pat. So you'll see that start to happen down the curve. You'll see the Fed make more moves over the next several months. So that now the bets will be on what's the next rate move. Will they keep it pat in the next session, or will they lower it some more? And so that's the big item. Let's go and look more in depth. The Federal Reserve delivered a swinging half percentage point cut to interest rates on Wednesday, the biggest single slice to borrowing costs since 2008. The central bank lowered the target benchmark range, and we talked about the range now that it is, and it's one of the biggest policies, one of the most aggressive policies in 40 years. It signals, I don't know if it signals a victory over high inflation, but it does signal that yes, they believe that they've done their job on inflation, and now they're moving towards other mandates. But that's the big thing here. The bank projected two more quarter point cuts this year. So again, quarter point, 1/4% cuts this year, and cuts totaling 1.5 percentage points in 25 and 26. Fed Jerome Powell reiterated remarks that central bank remains committed to reaching an annual inflation rate of 2%. So they still want to get to 2%. They're now at 2.5%. They still want to get to the 2%, but So yeah, it's really just again, the main thing is here either recession they see or they're going to have money printed to ease and stimulate the economy. Those are the two backdrops. It doesn't. We don't know which one it's going to happen yet. We have geopolitical risk, we have political risk, we have a bunch of things down the pipeline. But right now, the market is at least signaling as we start the trade day. We'll see if this fades throughout the rest of the day. Signaling they like the move. The market so far is signaling they like the move. We'll see if this holds throughout the day as we sit here and this folks that will be listening on a Thursday as we get this released. So big news, something we've been discussing on this podcast for many years, and people probably didn't get the implications or understand what was happening, but now you're starting to see it, what we've been talking about and what we've been discussing for a long time. Next up, um, we are going to look at Boeing. Boeing said they're going to furlough tens of thousands of workers. So, after warning earlier this week that the ongoing labor strike would prompt severe cost cutting measures, Boeing has begun furloughing a large number of employees, CNBC reports. For every 4 weeks, that approximately 30,000 machinists are on strike and aircraft production essentially halted. Affected employees can expect to take 1 week of furlough. Furlough CEO Kelly Ortberg said the furloughs will affect tens of thousands of corporate staffers, and his teams will be taking commensurate pay cuts while the strike lasts. The strike could cost Boeing about 500 million a week. So furloughing, could someone explain what that means as opposed to? I think it's just like saying, hey, it's on pause. Your pay is on pause. Everything's on pause until you come back. So, and he said that the executive leadership will reduce their pay during the strike as well, in kind, in a commensurate level. His annual base salary of 1.5. The CEO has an annual base salary of 1.5 million. Additionally, the company plans to select employees to take 1 week of furlough every 4 weeks on a rolling basis, the duration of the strike. So they're pretty much trying to cost cut measures because they have people that are on strike and it's holding up production. It's costing them a lot of money per per day, honestly. And so he's saying everyone will be furloughed, which I guess is just missing a week of pay every 4 weeks for them, and that's the structure of their furlough. And so it's really going to affect people. It's affecting the company. Boeing's a company that's struggling for a bit now. They have malfunctioning, defunctioning planes. They have strikes going on. They have to furlough people. That's a company that is in disarray. And we'll see what happens. They brought in a new CEO, if I'm not mistaken, and now they're trying to figure their way out of this. So that's going to be something we have to keep our eye on for Boeing, which is a huge company and one of our biggest transportation companies about. So we have to see what goes on with them. iPhone 16 demand. The newest iPhone, they're saying that it launches Friday. I didn't even know. I haven't paid attention to the new iPhone launches, but it does launch Friday. And they're saying the demand is kind of off to a slow start. Apple's employees can already buy the new models with their employee discount, and something they usually can't do several weeks after the release. But they're saying that it's off to a slow start. Pre-orders began September 12th. They sold about 37 million iPhone 16s. That's dropping nearly 13% from the iPhone 15's initial sales a year ago. Um, I actually might get a new phone just because I've had the same one for a bit now. I'm not a big have to always upgrade guy, but that's interesting. I wonder if it's just the fact, hey, they're coming out with these things what every 1 or 2 years. People are not going to always buy one, and it's a model that they have that works so great because of subscription, the ecosystem, everything. We know what Apple is as a company. So saying the demand disappoints is understandable, right? You're putting something out every single second, not every time. It's going to have the same demand effect as it does prior time, especially if you're not upgrading it significantly, which is really hard to do to make innovative changes every time you release a new model. So this doesn't surprise me. They have a growing ecosystem of loyalty. They have AirPods, Apple Watches. Those revenue business lines are growing. They have service over hardware. They're shifting, are people shifting to older models like 13, 14 have increased. It looks like people are shifting to older models for choosing affordability. And so again, it's one of the greatest companies. It's just the fact that you're not always going to be able to draw in a customer based on innovative moves every single time you release a new model. So that's understandable. Look at Dollar Store, juxtaposed to Dollar Store. That's a company that had a really decent earnings, if I'm not mistaken, last report session, but they're kicking in on real estate. The nation's largest chains, Dollar General and Dollar Store, together are set to open more than 1,300 new locations this fiscal year, betting that the ubiquity will be key to boosting their struggling businesses. But it may be a risky proposition. Their core customers, who make 30,000 or less annually, are shopping less overall thanks to price pressures. Rivals price cuts are also making a dent as Amazon expansion delivery to more rural areas that might previously have relied on the convenience of nearby dollar stores. So they're saying, hey, we believe even in this economic environment, the people are going to come to our store and flock in. So we're going to expand. Dollar Store, John Joe, the discount value retail stores are looking to expand because they anticipate a recession coming where people are going to start flocking to their lower prices versus paying higher prices for convenience at Amazon or any of these other, higher price retail places. So that's an aggressive move. I don't know how well this will pan out, but it's an incredibly aggressive move that will be, one to watch. I mean, Dollar Store, Dollar General, these big box, low margin discount retailers, are they able to really do what they need to do by expanding? Um, they'll open more than 1,300. I keep saying 13,000 new locations to drive more growth. Interesting. I'm really curious on how that could play out. I don't see it playing out well, but they should know their businesses more than anyone else. We'll see. We'll watch that very closely. Let's see if there's any other news. There was big merger acquisition moves. So Alaska Air is acquiring Hawaiian. It's a $1.9 billion merger. And it's clearing the runway for the first major U.S. airline acquisition since 2016 when Alaska scooped up Virgin Atlantic. For Hawaiian, the deal is seen as a lifeline. While Alaska is expected to level up its biz with more planes, workers, and customers, it'll control half of Hawaiian's air travel market. The DOT's approval, which includes binding conditions, comes about a month after the merger made it out of antitrust review unchallenged. So that's big merger news, especially in the airline space. Let's see if there's anything else. Amazon is ordering employees back to the office 5 days a week, RTOing peers, out RTO and return to office peers. So again, a lot of the tech sales, excuse me, a lot of the tech companies said you can, hybrid work from home, work in the office, just kind of depending on what the situation is. But Amazon's saying they're coming back. It's going to start in January. Last May, it started requiring 3 days in the office, which led to protests. And then Andy Jassy said disgruntled staffers should disagree and commit, suggesting that they should quit. That's a good way to say it. Disagree and commit. So say it with your chest is pretty much what he said. And if they didn't like it, they should quit. But now he's saying everyone come back. January 1st, you all come back. He said that work from home days weren't a given pre-pandemic and that working in person strengthens Amazon's culture and collaboration. The studies on whether employees are more productive remotely versus in the office are complicated. While some remote workers grind out more deliverables in the short term, their future output could be negatively affected by lack of desk buddy mentorship. Yeah, that's interesting. I don't know what the answer is on that. I know speaking, anyone that worked in a cubicle or office before would say that they would have loved working from home. That's just the basis fact. Like I just work better by myself. So for these people, it's interesting. I've worked for where I wanted to for the last 4 or 5 years now, and I love it. Like I could not imagine have to always going back into office when I have my own office at home. Um, so yeah, I just couldn't do the commute, couldn't do the travel, couldn't do it. I just couldn't do it. I just couldn't do it. So I mean, most people, they'll be forced, they have no leverage. They'll be forced to go back in, and they'll be forced to succumb to whatever they got going on there. So, but it's interesting if other companies will take the effect. I don't know. A lot of tech companies have still said it's hybrid and can do what they want. They've still printed money. So it's really just basis of like what they think they want their culture to be. And if they believe productivity is slacking from work from home measures. So that's going to be really, really something to watch here going forward. I think that's about the main news. We talked about the Fed rates, cutting rates by half a percentage point, which is a big move. Again, the market's cheering that so far. We did talk about some of the bigger acquisition moves. The one thing we want to talk about on the roundtable today, one of my clients called me and explained to me a situation where they invested in something else outside of New Street. Again, people have the prerogative and the ability to do so. And this person invested in something else that was pretty much, we're following up, but it doesn't seem like what this investment move was above board. It doesn't seem to be from the information I've gathered so far. It doesn't seem to be that this was above board. It doesn't seem to me that this was um something that was legitimate. And so it's just a warning to people. One, if you hear something that's too good to be true, right? Like that's why I'm always transparent and tell people the facts about what investing is and how you're not going to become a billionaire just by putting money in, or how you're not going to 10x just by doing something. If something's promising you these things, it is 100% not real. It's not realistic. And it sounds too good to be true. It usually is. Unfortunately, for people out there, there's no quick way to doing things, right? There's no quick, it's a lot of years, a lot of things of work ethic, saving, doing different things. You're not just going to have some like magic box that just unveils something to you. So if someone tells you that, and they're telling you to put yourself in a financial strain to give them money, which they're going to return to you tenfold, it's not possible. Like that's just the facts, right? Like if they had figured that out, they would just do that themselves and not ask for outsiders capital, right? And so this situation again is something that I think you'll find out later. We're going to look into it. I'm looking into to help this person because they brought it up to me afterwards. They'd already done this move, it had it years back, and they bring it up to me because now they're looking for help. And again, I'm being the person I am. I'll help all my clients with all their situations, even if I wasn't involved or not. It's a situation where, again, we're probably going to hear about this because depending on the amount of people that were swindled in this potential scheme, where they've admitted that someone ran off with some of the funds, this is going to be something that may be bigger than we know. I don't know anyone else that was in this yet, and I'm trying to help this person make the next moves to report it, and to not only report it but to get whatever retribution is. Usually in these situations, which is sad, the you can't really recover all that was lost, right? So someone made a mistake trusting someone that wasn't trustworthy, and then they can't recover all that was lost. But we're gonna make moves. This is another warning to people out there. It was happening a lot during 21 and 22, and this seems like to be like a late bloomer, alleged scheme here. And so again, if it's someone saying something that's too good to be true, it is, right? Like don't get yourself caught up in that, understanding that people that are transparent and real with you are the ones that are doing good things, and you just people that are selling false narratives and saying things that aren't true or probably don't have a good intention. So again, this is a warning, a roundtable warning to people. There's always going to be those schemes. They never go away because it always works on people that don't have you know the wherewithal to know what's good and what's not, or they're not leaning on expert advice. So again, a warning, we're going to look into the situation and try to get this resolved. For this person, this person has to make the moves to do this, to do that. I can't like force the person's hand, but we'll keep people updated, and you might see this if this is what I think it is. Allegedly, you might see this, pop up on your news streams at some point. So again, come to me if you have questions, right? Like people need to use me beforehand before they make these decisions, and I could give you my transparent, honest advice, right? That like I always do as a fiduciary. Come to me if you can before these decisions so that you don't end up in a situation that's, not great for you, that's not good at all, that could derail your financial life, truthfully. Like that is what's happening to people in this situation. So again, come to me. I'm one of the best doing this, if not the, and I'll give you transparent audit advice. Again, that's if you're a client. If you're not a client, do not come to me. With that said, this is another episode of the Your Money Your Life podcast. We do this every week. Make sure you like, subscribe, 5-star rate and review, and share this podcast. We'll talk next week.